Okay, thank you. So without further ado, let us begin today's morning call from the research team. Today we'll be talking about some stock counter updates from Raffles Medical, UOB, OCBC, followed by some technical updates on Singapore and some Singapore Weekly, followed by Paul, who will be talking about PropNex, Venture, StarHub, Siong, Penguin, and APAC. So there'll be quite a lot of counter updates. So yeah. Okay, so first of all, let us start with Raffles Medical Group. For Raffles Medical Group, the positive coming from the financial year 2019. So we see a sustaining strong revenue growth with 8 consecutive quarters of revenue growth. So for Raffles Medical itself, what they do is during the financial year end, they actually announce the entire years and not just the fourth quarter. So unfortunately, we are not able to see. They didn't really discuss what happened exactly in the fourth quarter, but they talked about the entire financial year 2019 as a whole compared to financial year 2018. But what we do see is that healthcare services, which is the clinic network, its revenue grew 9% year on year, with an expansion in the corporate client network, as well as an increase in the scope of services on both new and existing insurance contracts. So yeah, that's for healthcare services. And then for hospital services, it grew 5% year on year on a higher patient load as well. So I think part of this also came from the opening of the Raffles Hospital Chongqing. So what happens is it finally opened for one entire year, so you can see the impact on its revenue. And then on top of that, Raffles Medical also recorded a very strong cash position of $150 million, which is up 43% from financial year 2018. So this is despite them paying up to 100 mil for fixed asset under development. So which in this current point in time when there's higher volatility, right? It can help them tide through some short-term liquidity problems. Furthermore, apart from the strong cash position, they also have some existing untapped credit facilities that can provide further buffer during this period. So what about the negatives? We see that there's an ongoing pressure from gestation costs. So the EBITDA grew a modest 2.8% with Raffles Hospital Chongqing, right, incurring $9.2 million of gestation losses in the financial year of 2019. So if we remove the impact of Chongqing from Raffles Medical's EBITDA, they actually say that the EBITDA would have grown 18% year on year. So that's impressive. But the $9.2 million of gestation losses, right, actually came in within the target of Raffles Medical itself. So previously they guided for first year gestation losses of about $8 to $10 million. So yeah, this is just slightly below the higher band. So in 2020, they are expecting these gestation losses to narrow to about $4 to $6 million, and probably in the upper band as well, currently looking at how the coronavirus is panning out. But on top of the gestation losses coming from the Chongqing Hospital, the opening of Shanghai Hospital in 2020 will add on further pressure to the EBITDA margins. So yeah, that might be a short-term headwind for them. So we look at the outlook and updates. So right now, when discussing the virus outbreak impact on its earnings, we see that because most of Raffles Medical's business come from elective treatments, actually patients are advised to actually delay their elective treatments. So it's not very urgent. They can push it 1 quarter back or 2 quarters back even. So this might cause some short-term earnings impact for the the immediate quarters to come. As well as we can see that because for the China side, there's an extended periods of closure for some clinics. They did mention that not sure whether it's a good thing or a bad thing, because during Chinese New Year, generally what the Chinese do is that they avoid the clinics. So generally it is already a lull period, but the fact that they are not able to go back fully into operations right after Chinese New Year, the impact might be more pronounced this time around. Then for the 2 hospitals that I mentioned previously, Chongqing and Shanghai, for Chongqing itself, the good thing is that right now they actually obtain coverage for China's social health insurance scheme, which is the Yipao. So what happens is that they actually, the locals can actually use Yipao to pay for the services, so they can help to bolster some demand for them. And furthermore, the Yipao scheme actually expanded in scope. So previously, right, for patients who want to use EPAL. They can only use EPAL to pay. So whatever add-ons that they want to using cash, they are unable to do so. But right now, they can opt in for more services through a cash top-up. So not allowing Raffles Medical to have the flexibility to open up more beds to cater to this demand and won't hit their margins as badly because people will only go for the cheapest if they are using EPAL. Then for Raffles Hospital, Shanghai, actually all the renovations have been done. They are ready to actually open in the second quarter this year. However, with this current virus outbreak, they might delay the opening until everything normalizes again, because once you open the hospital, you might start incurring all the operation costs. So yeah, but the longer they delay this, the gestation costs will be pushed back further and might possibly extend. So that's not a very good thing as well. However, for the Shanghai market itself, what they are observing is that because most of the Shanghai people are expats, so they are usually covered under corporate coverage, medical coverage. So they are not as the success of the hospital is not as contingent on them getting the EPAL coverage as compared to the Chongqing's one. So this also impacts them because for you to get the EPAL, right, you need to start operating, and with the delay, it might take longer for them to get the EPAL approval. So with all this corporate coverage, it is easier for them. And hopefully the gestation period will be shorter for the Shanghai as compared to the Chongqing hospital. So right now, we're maintaining a neutral call with a revised target price of 99 cents from the previous $1.05. So in the next 1 to 2 years, we feel that China's expansion will continue weighing on performance, especially in terms of EBITDA. So hopefully by the next 1 or 2 years, when the Chongqing side break evens and start going profitable, it can help to offset some of the gestation costs coming from the Shanghai side. And we see that if the COVID virus were to mimic that of the SARS period, they are seeing that impact on revenues will last maybe 2 quarters. However, longer term prospects for the business is still intact when they start, when all this expansion phase is past and all the short-term volatility is past. So right now, I'll be talking about UOB. For UOB, the positives, the other non-interest income actually grew 127% year on year. So this is a very stellar result. Trading income quadrupled on some gains on investment securities, and there's better customer-related flow income. So when the market is doing better, all this income gets boosted. So we see that net interest margins and fee grew a modest net interest income and fee income both grew a modest 2% apiece. So that is just a very stable income source for them as well during the last quarter. However, for the negative, when we look at the expenses, we can see that for the fourth quarter cost to income ratio, it actually rose from 44.4% to 45.9% year on year. So we see that IT related costs, expenses actually grew 36%. There are additional staff related costs that grew proportionally with income growth, such as performance related fees. And we also see that allowances rose 14% year on year on the impaired loans. So nevertheless, I don't think this is a cause for concern right now. There's still, for them, it's still a benign asset quality with the non-performing assets growing at 2% year on year on a low base in 2018. Right now, the credit cost actually rose 4 basis points to 24 basis points in the fourth quarter, but the full year credit cost came in at 18 basis points, which was lower than the 20 to 25 basis points that was guided by the management. And we see that non-performing loans ratio was unchanged at 1.5% year on year. So all this is pretty good still. In terms of outlook, right now UOB is taking more of a de-risking stance when it comes to managing the North Asia exposure to help insulate some short-term risks arising from China and Hong Kong. So since last year, second half of the year, with all the Hong Kong unrest, what they have been doing is to take on a more safe approach when it comes to managing their exposure in. Currently, the Greater China exposure stands at about 15% of total assets, and potential vulnerable industries in Hong Kong make up about $5 billion or 8% of the total Greater China exposure. So this is still kept pretty low. And a large proportion of the loan tenor is below 1 year, with the non-performing loan ratio below 1%, which is very respectable. So, and to them, they feel that if it turns for the worse, they can always cycle out these loans within 1 year. So yeah, the cost is not much cause for concern. However, as with all the other banks, we see that there's a sluggish growth outlook on macroeconomic uncertainty. We see that there will probably be some NIM compression, which will stunt the net interest income in financial year 2020. And non-interest income may also take a hit from the weaker market sentiments, as we can see in the equity markets right now. But right now, we're still maintaining an our accumulate call with an unchanged target price of $27.80. We see that there will be stability in financial year 2020, as we have already did some downward revision in the previous quarters. Okay, so right now, we will talk about OCBC. For OCBC, they actually produced a very good set of results for the fourth quarter 2019. First of all, we can see that fourth quarter net interest income actually grew 6% year on year on better net interest margins and a modest loan growth of about 3% year on year. So net interest margins expanded 5 basis points year on year to 1.77% in the fourth quarter, and we see that there's a steady net interest margins quarter on quarter, despite more pressures on the margins due to them managing the lower funding costs from a lower asset use by lowering their funding costs. Then secondly, we can also see they will have a record quarterly fee income again. So this grew 17% year on year, which is recording a fourth consecutive quarter of growth since fourth quarter of 2018. So they attributed to the fees income growth to strong wealth management fees and loan-related fees. We also see insurance income recovering. So the premium income increased 7% year on year, while investment income reversed losses in the fourth quarter compared to the previous year. So the Great Eastern franchise is actually doing much better in the fourth quarter as well, which contributed more. So for the entire year of financial year 2019, they actually increased contribution by 38% to $832 million. Of course, then we also see other non-interest income quadrupling on better trading income. So these are driven by treasury activities, a rise in customer flow income, and some mark-to-market gains. So as I mentioned for UOB as well, so this is the same quadrupling of trading income, etc., probably on better market sentiments as we have seen in the fourth quarter of 2019. As for the negative, there's really nothing much to pick on. We can see that for them, maybe the operating expenses rose 17% year on year, so which was mainly attributed to staff costs under Great Eastern Holdings. But we know because the insurance business is quite driven by manpower, so it's quite hard to avoid as well. And although it increased 17%, I think the impact was not really felt in the cost-to-income ratio, which was offset by their stellar earnings results. So in terms of outlook, OCBC currently they are exhibiting a strong financial and capital position. So the CET1 ratio is at 14.9%, which is the highest among the three banks compared to 14% a year ago. So as a result, they also proposed a final dividend of 28 cents, bringing the entire 2019 dividend payout to 53 cents compared to 43 cents in 2018. Moving forward, we are expecting them to give out the same 28 cents per semi-annual. Yeah, so as part of their policy to maintain a sustainable and growing dividend. But of course, we're not expecting them to grow immediately. We're expecting them to at least maintain these 28 cents for every 6 months. And although we know that in the third quarter of 2019, they actually did a one-off write-off of some OSV loan book. And by right, the asset quality should be improving in 2020, but the management did come out and say that the improvement in allowances will be offset by the impact of the COVID-19 virus. So even though it will be about a 10 basis points improvement, if not for the COVID virus, all these 10 basis points might be eaten up by the COVID virus impact. So in terms of growth outlook, stimulated as well. NIM contraction coupled with a slow and negative loans growth from poorer market sentiments will weigh in the financial year 2020. So mainly the growth will be derived from fee income and trading income, but that will depend a lot on the market sentiments as well. So it's very hard for us to determine until we get a better picture as we move along the financial year. So right now we are maintaining our accumulate call, but based on the stellar results, the target price has been upgraded to $12.10. So there's no change in the underlying assumptions to our model, and we continue to maintain on the lower band of the management guidance. So you can see some of the assumptions that OCBC actually gave in terms of their NIM, loans growth, and some credit costs. We are all taking on the more prudent side of it. Okay, so without further ado, I'll have Weiren talk about the STI.
Thank you, Wei Guang. So move on. Today I'll move on STI, and then later on I'll move on down on how the market moves based on technical perspective after the coronavirus scare. Okay, so without further ado, let's move on. So for STI, the weekly chart shows that there's a persistent weakness, and we may be seeing STI going lower than 3,000 support level in the long run. So immediate support of 3068 has been invalidated. So where's the 3068? So it's basically the support line, the blue line above the support level 1, above the 61.8. So although there's this morning there's a slight bullish recovery, however the support level of 3068 must be broken to confirm the renewed bullish trend. And also do take note that above the 3002 there's also resistance zone 1 and then subsequent 3004 there's a zone 2. So even though there may be a possibility of a bullish recovery, but it will be more likely a range bound and tilt towards the bearish side. So also do take note that should the 61.8 Fibonacci retracement of 2528 to 3641 is broken, we might see price travel further down to 2898 to 2857 as a immediate support zone. So without further ado, let's move on to Dow Jones. So for Dow Jones, there's a strong downside in a week. We see Dow Jones fall more than 1,100 points within a week due to the coronavirus scare. So although there's a slight recovery on last Friday at the support level 1 at 2471.24713. However, we believe that there might be a renewed selling at 26,000 to 26,500. Why? Because in the daily chart, if there is a slow skewing of the bullish momentum, there may be a potential bearish pennant or bearish flag forming. So the potential reversal, we will see that 26,548 or to 26,500, or it may be at 26,000 near the 23.8 Fibonacci retracement level. So although there's a bullish hammer taking off after rejecting the demand level of the between 24,670 and 24,963. So if there is a slow bullish momentum, we will see a bearish flag forming. And then do take note that you may take note of the stochastic to indicate the momentum as well. So I move on to Paul for PropNex. Thank you.
Thanks, Weiren. I'll move on to PropNex results. Okay. In terms of the results, the numbers beat our expectations. I think, which is obviously because there was like a threefold jump in earnings. The reasons why the earnings was better than expected was driven by project marketing. Project marketing basically means new launches. It's up almost twofold. So this is the first positive from the results. The other part was even the resale market, the private resale market has started to recover. As you know, the big problem for 2019 for most of the real estate agencies was the weak private resale volumes, which we will discuss more a little bit later. But what happens is that we're beginning to see some stability. So quarter on quarter has been a bit turning flat. The only negative, which was actually quite hard to find, but actually was the dividend per share. Full year came in at 3.5 versus our 3.7 cents. Although the company has no formal policy, I think they mentioned that they want to be a dividend paying stock. And I think they can afford to do so. I mean, to keep this 3.5 cents, they need to pay like almost like 14 million of dividends. They already have 80 million, so they can actually continue even without any cash flows. But last year they generated almost 27 million, which is double the dividends that they pay out. So they can sustain this the current yield about 6% for for many more years. I mean, unless there's some really major collapse in transactions. But apart from that, I think the 3.5 cents can be actually quite sustainable for several more years. So you can expect them to keep a high dividend yield, and this won't be a one-off. Okay, in terms of outlook, all three segments are doing well. I think what you see that the 38 launches ready for this year, and they're still marketing another 104. One of the reasons they do well is, sorry to move, I forgot about this chart. They've actually gaining market share. You can see that they almost out of every project new launch in Singapore, they have like 48% or half of it comes from their agency network. So they almost have a 50% market share, and even the resale also is speaking up. So going back to the second part, as you know, the business has three parts. There's new launch, then there's private resale. So what has happened is that in 2017, 2018, private resale transactions usually range 13 to 14,000. But last year was basically horrible. It dropped to almost 9,000. But I think if you assume a normalization, which we begin to see some pickup, even if you assume back to 10,000, this is probably going to be a growth impetus for them in 2020, sorry. And don't forget 2019 first half was also especially weak, was very weak for them. So some of these will be some of the reasons why it could drive growth. The other reason is another part of the business is the HDB resale. As you can see, and after the improvement of the enhanced CPF grant and higher income ceiling, you begin to see some pickup in transactions, and that's why in the fourth quarter, HDB resale transaction rose 12.5%. Of course, there's also the minimum occupancy period of 5 years starting to hit, and a lot of these units are available for the minimum occupancy period. So anyway, we maintain buy with a higher target price. I think what stands out for us is their significant market share, like mentioned earlier, the impressive unlevered ROE of almost 30%. So if you remove the cash, probably their ROE is probably double this amount. And also their net cash is about 82 million and the attractive yield about 6.4%. Okay, I'll move on to the next stock. I got a number, I think I got 6 stocks to cover, but I mean for fourth quarter venture results, the outlook is basically a good outlook for 2020. Okay, anyway, I'll move on. In terms of the positive, actually the revenues was better than we expected. I think we were estimating a decline of 7%. So the results beat our estimates and also the consensus numbers. Some of the negatives were there was a big spike in trade debtors, quite huge. I mean, it's almost a 200 million jump in trade debtors. But I mean, they mentioned that these are to tier 1 customers. And there are typically some offsets. I mean, for venture to give such good credit, obviously they could get some better pricing or from the customers. The other thing was OPEX was the one that also rose. I think there was a jump in OPEX and other operating expenses. But regardless, the numbers actually still beat our expectations. In terms of outlook, the outlook is good. I think first quarter could be soft. I think they are not immune to the global disruption in the supply chain. But outlook in 2020 will be driven by two main areas. I think what has happened is that because of this outbreak, I think there's even more outsourcing into Southeast Asia. And as you know, venture has largest footprint for them is in Malaysia. So what has happened is because of this outbreak, what we've seen more customers looking to want to qualify that. So they want to qualify ventures plants in Malaysia and also some of the raw materials that is sourced out of Southeast Asia. But of course, all this will take time. So you only will probably see the full impact of this phenomenon probably in the second half. The other reason why growth in 2020 will look good is because they also mentioned, I mean, in their statement that there will be no new products and customers in life science and healthcare. They did not disclose the names, but the fact that they mentioned this, obviously they've got new programs coming up from existing and even new customers. So we maintain a current with higher target price. I think our forecast we're not forecasting very aggressive growth, but even with that, so the target price about 18.10. Again, some of the rationales for buying them, they've been capturing profit share in the whole global sector and also the yield and also the healthy ROE and net cash. Okay, I'll move on to StarHub results. Okay, StarHub also beat our expectations. What has happened is that we're beginning to see some stability in the revenue. As you know, for telcos, the revenue is recurrent. So as a result, you can actually use the quarter-on-quarter. So you can see that quarter-on-quarter revenues is starting to stabilize. The big one is mainly mobile. I think what they mentioned was that pricing by competitors has actually turned a bit more reasonable. That's why even the postpaid ARPU quarter-on-quarter actually rose. Year-on-year is down, but quarter-on-quarter is up. And there's even stability in the, like a better word, kind of problematic pay TV business. So the other large driver for the EBITDA growth, you can see EBITDA was up 25 or service EBITDA 9, because there's some accounting, change in accounting that kind of elevates this, but it was also up because they managed to cut their operating costs by 4.5%. So they've done a lot, the new management has done a lot in lowering operating costs. Okay, the negatives was that the pay TV, we thought that after the migration from cable, just to recall, StarHub disconnected cable and moved everyone to fiber. So we thought subscribers wouldn't drop, but actually it still fell, but because there was still some churn of 18,000 customers. Some customers decided to leave only in the fourth quarter. Anyway, in terms of the outlook, again, we think it will be a more stable year for them. I think we're not expecting like stellar growth. The only growth area for them, at least for this year, would be cyber. But we think that it's still attractive. I think they're paying almost a 6% yield. And there's some stability across the board for all their operations. And could even surprise on the upside if you get some growth out of mobile from rising ARPU. And also the earnings upside also come from even more, actually not say, it's cost rationalization, especially content costs. Move on to Siong results. Siong results actually was below expectations. Part of it was due to the difference in the accounting standard. So I think if you adjust for this, actually would have met our expectations. I think the good news for the positive from the results was the revenue growth is still very strong. And the one that surprised was this part here. This is same store sales growth. So these are for the matured stores that are not the anything, new stores are considered 2 years. So these are stores that are older than 2 years. They were opened more than 2 years ago. So and then you're beginning to see some stability. It rose 1.8%, and after 4 quarters of decline. So that means organically, without new stores, they're starting to grow again. And we also see this in the supermarket industry data for Singapore. Okay, there are positive gross margins, but that has been a story for a long time. And the negative was there was a large jump in the distribution, but it was more, and also effective tax. But this was due to some adjustment that they normally do in the fourth quarter. Okay, anyway, we are positive on outlook also for Siong. There are multiple earnings drivers. I think the store expansion is underway. So that will be, as usual, the new stores is a big driver to grow. Then the second part is that, like we mentioned earlier, this was something that we didn't get in 2019, which is the improvement in consumer sentiment. And also they mentioned, and also I think Chinese New Year for their first quarter should also be very robust for them. I think the first quarter 19, the prior year was very weak. And they will not be releasing quarter results, but they will give some updates. So we should see some very good Chinese New Year first quarter numbers due to the better Chinese New Year, and of course, the mad rush for supermarket items a few weeks ago. Okay, and then, so I'll move on to the third point is, of course, as you expand stores, the productivity won't be so good because it's a new. So we also think that another growth driver will be the improvement in productivity, because it actually felt, this is, you measure sales by per square foot. Okay, I'll move on. So we still like it, and we just raised our target price to 141. Okay, I'll move on to the next. Also, Penguin results. The title is Swimming in Cash and Orders. Okay, I'll move on to, anyway, why is swimming in cash? I think we can see that there's a big jump in their net cash, 43%. And also there's a big jump in we call this an order book proxy. As you know, for Penguin, they do not disclose their order book. So we have to build our own proxy. Okay, our proxy is like how much inventory they have, how much held for sale, and other payables. So what we think is that, firstly, the first positive is the cash is now almost 40% of the market cap. The second thing is that our so-called order book proxy doubled to 86.9 million. So this, just to give you an example, so they will build inventory here, and then they usually have customers to purchase. And how you get a sense of whether the customers is from this line item here. So if customers come in and give deposits, it's considered payables, but actually it's more like deposits. So when this thing rise, then you know that customers are putting a lot more deposits in to buy the vessels here. So that's how you get some flavor of how well they're going to do. The negative was charter revenue. I think we really want to see this growing more, because recurrent revenue, there's more value in the recurrent revenue, so that it's not one-off like some of these projects, maybe shipbuilding contracts. And in terms of outlook, multiple drivers, I think there's no different from 3 months or even 6 months ago. Why they're doing well is that they managed to diversify into new products. I think they built up their design team with new hires and so forth. That's why they managed to enter into new products apart from their usual crew boats and security boats. And also, they've also expanded into, this is almost the same thing. Because of new boats, they also mentioned to new geographies. Of course, there's been some oil and gas recovery. Competition has also come off. I think there have been some headline kind of bankruptcy, so that's why they kind of helped them. And also, this team will continue to grow. Okay, anyway, we maintain a buy. If you take out the current valuations, if you take out the cash, it's only 3 times PE. Our valuation is 5 times PE excluding the cash. Okay, APAC Realty, again, PropNex results probably overshadowed them. I mean, although they did well, they've actually up about 32%. But I think because of the better performance out of PropNex, I think our preference, at least at this point, will be PropNex. Although they've also done well, I think they've also raised the dividends, and also we can see a recovery. So for them, a recovery is underway. If you want to know some of the updates that they mentioned, you can just read here. Yeah, some of the commentary that they have on the new sales, or let's read the report. Okay, I'll move on to our Singapore, just a quick update. I usually for Singapore Weekly, we usually provide economic data, but I think there's no point now. I think with this outbreak, all the data probably not relevant at this point in time. So I mean, just a reminder, so far our market this is what happened to the STI during the SARS period. I think we've shown this before, but just a reminder, when in 2003, when we had the first school closure, the market is down about 6, which is almost exactly like how the STI has performed this year. So again, this is more like a guess. So depending on how deep, if things stabilize, then you could see the market start to recover. But from the very first time we had a SARS outbreak, the market dropped until 14%. Again, these are all guesswork. So how much more I really can't say, maybe another 2-3%. But again, once this thing starts to stabilize, you're going to get a big pop. When Singapore exited the WHO list in May 2003, you can see there's a big pop in the market. So I'd rather be ready to play. I'd rather be ready to play this rebound than to sell into this level. Okay. Anyway, just to give you a refresh in terms of the global cases coming up, ignore this part because these are all WHO numbers. So this part here was because they changed the way they compute. So you can see, anyway, I think which is the obvious thing. I think the cases in China is coming off, but cases globally is coming up. I think the market won't kind of relax until you get all these things start to come collapse back to the usual kind of 200-300 outside of China. So this is the blue one is outside of China cases. The red is China cases, which actually which you can see has collapsed quite a lot in terms of new cases. So they're containing it, but it's only the rest of the world. Okay, in terms of the usual update of our model portfolio, so we also can't avoid. I cannot, although it's called supposed to be absolute return, we also cannot avoid. It was a negative 1% for us. What has done well was actually really just selected winners that did well for the portfolio due to their good results and outlook, like we mentioned, PropNex, Siong, and Venture, and also StarHub. I think the one that got hit badly for us has been Singtel, because Singtel, I think Australia is becoming a major problem, at least operationally for them. So this is the performance. I think year to date, the market is down about 6%. Again, the sectors that did poorly was the usual subsects, transportation, telcos, even some of the, and of course, the retail REITs and the banks were actually down for. Okay, that's it for us. Any questions? Thanks.
Okay, for the banks itself, currently, right now, I think all 3 banks got sold off, but we can see that actually the selling off for OCBC is actually much lesser compared to the rest. I think because of their stellar 4th quarter results. You can see actually it kind of moved in tandem with how they performed for the 4th quarter. So you can see actually UOB actually fell more, followed by DBS. Then OCBC is the one who fell the least. But if you say in terms of which bank is more attractive, I think currently all kind of, okay, generally the entire market is being sold off right now. So any of them are all looking like a very good, very attractive. So, but if you really want to look at how, which one might be preferable, I would say when you look at the dividend yield, generally, I still feel that maybe OCBC and DBS in the short term is still better. But in the long run, when it moves out, generally, a lot of them are talking about the exposure to the North China area. So yes, UOB will definitely be more insulated in the sense that their exposure is only 15% compared to DBS and OCBC, who are at like 25 to 30% of their exposure to North Asia. But when we count into the fact that generally when they have exposure to North Asia, it's all very very safe. Yeah, they're not like very bad loans or something like that. So yeah, it's all quite good. And currently in terms of yield, DBS and OCBC are at a higher yield because UOB, they usually, what they do for the dividends is that they one-time pay off at the end of the year after they know how much they earn for the year. So it gives out as a special dividend. Whereas for DBS and OCBC, when they commit DBS for quarterly and OCBC for semi-annual, it provides investors with a more foreseeable kind of cash flow for investors lah. So yeah, right now that's what I feel is the current situation.
There's a question on what level should we start to buy Singtel. Actually, it's a good question. So if today price manage close above $3, you may actually do a spot buy tomorrow. If it close above $3, like 3.01. However, if it does not, you may look at 2.93 to 2.95 region. There is a very huge supply, a huge demand over there. Okay, thank you. I hope that answers your question. There's a question, or is it now a good entry point for STI stocks? For the banks, I'm not very sure because the banks still are displaying some bearish, based on technical, is still displaying some bearish outlook. So for STI stocks, I think that unless the general STI is break, I still maintain above 3,000. And what I mentioned on the slide is if it maintain at the above the resistances support level at 3058, if I remember, then it is a safer bet to say that okay, then we can enter all the STI stocks. Otherwise, I will just keep a look see attitude. Thank you. I hope that answers your question.
Hi, so we have a question about why the REIT shares are going down. So I think over the last week, the REITs, a lot of the REITs actually suffered negative price gains, price losses rather. So we think that this is because of just some correction in the pricing. Yeah, and also not to forget that there's some REITs that have more exposure to the China market. So I think starting this week, you can start to see that that prices are actually rebounding for REITs.
Okay, for DBS itself, cause yeah, I think it's been 2 weeks. I think for them, right, the main thing that differentiates them between them and between DBS and OCBC and UOB is that they have very strong investment banking franchise. So in a sense, their fee income is more poised by this kind of fees. Whereas for the OCBC and UOB side is more of wealth management, etc. So moving forward, I would say actually there were quite a lot of capital markets movement slated to be for this year, but not sure whether in terms of 2020 how it will be affected by this virus outbreak. So right now I believe that in a sense they are still very stable moving forward.
Yeah, thanks for all your questions. We've got one question on Netlink recently filed a report mentioning that they are terminating the service of an IT contractor. Actually, I don't really see any, I mean, for me, I don't see any impact. Always remember Netlink's biggest asset, it's not really the IT system, it's really the ducts. You can say virtually it's like the hole on the ground that they've dug all the way, all the fiber connections that go to our homes. I don't think anyone can replicate it. All the digging, all the right of way, and the government only gave them, they're the only one who's licensed to do it. So that's really the main asset. I don't think IT systems would really matter. I think that is their core asset. The right of way into all the homes, all the fiber connections to every home in Singapore. I think that's the biggest asset. Yeah. Okay, there's another question, view on ComfortDelGro and Sheng. Okay, we don't cover Sheng, so hard for us to comment. Sorry for that. But for ComfortDelGro, near term will be very, very challenging. I think we all have seen. I mean, they're getting hit in China, and getting hit in Singapore, and they also have to come up with the rebates, and the rebates are all out of pocket. rebates as in the rental rebates to the taxi drivers. So I think near term will be extremely challenging for them.
Hi, there's a question on what's the outlook of Jardine CNC and is it good to accumulate the share? I would say not at the moment because based on the weekly chart, there's a strong downside momentum and then it break the psychological support of $28. So we believe that the next price is going to hit its weekly support is actually 36.22. So I would suggest that you look at the $36.22. Okay, and then there's another question on gold. So gold, I think that there's a short upside at least for now to $1,620. And then lastly, there's a sets outlook. So for sets, there's a strong bullish upside today. So we need to actually for sets. Okay, for sets, if we manage to close above 4.19 by the next 2 days, I will believe there's a short-term upside. But do take note that 450 is actually there's a huge supply level, so it may reverse at 450. So otherwise, do keep a lookout for 4.19, $4.20 for sets. Thank you. I hope that answered your question. Thank you.
Currently for Vicom, we do not have any coverage, but then I think when there's a share split, usually it's more of there's more short-term bullishness on the counter. If you're thinking of whether to enter now or wait until it splits, I don't think it really matters. But because after it split, it's still about $2. So when you talk about how it will be trading on the market, it's still $2. $2. It's still moving in every 1 cent. So that will be a bigger difference. So I think if you want to buy, you can choose to buy now. But yeah, that's just a personal view in terms of how it usually reacts before and after a stock split. For Mapletree and Mapletree North Asia, we also do not cover it, so not able to provide a very good answer. But right now, I think the fact that most of the stocks with especially North Asia exposure, China and Hong Kong, generally is just being sold down more than the other stocks that has more limited exposure. I think just now there was a question on whether there's any recommended dividend stocks to accumulate. Okay, right now with all the prices falling, right, of course, a lot of the counters will have very attractive dividend yield, but we know that because dividend yield is always based on the past dividend. So moving forward, right, I think it is better to look at stocks that actually commit their dividend. So in a sense, some of the REITs, because REITs, they have 90% payout ratio. So that's something we can look forward to. But because there's still no commitment, it's based on how much their net property income is and etc. Whereas you see like counters like from the banks, when they actually can kind of commit based on their CET ratio, right? I think that is something that you can consider as well for you for dividends.
Okay, so everyone, thank you for all your questions. Our session's running kind of long, so we will end it here. Thank you for tuning in.